Welcome to our exploration of confirmation bias in investing. This is one of the most common psychological traps that affects investors at every level. Confirmation bias is our tendency to see what we want to see, and it can seriously damage our investment returns. Understanding this behavioral finance concept is crucial for making better, more objective investment decisions. Let's dive in and learn how to recognize and overcome this powerful mental bias. Confirmation bias is the tendency to search for, interpret, and remember information that confirms our pre-existing beliefs while ignoring contradictory evidence. In the context of investing, this means we actively seek out data that supports our investment thesis and dismiss warning signs that challenge it. For example, if you believe a stock will go up, you'll naturally gravitate toward positive news about that company and overlook negative reports. This isn't intentional deception. It's a hardwired human tendency that affects all of us. Confirmation bias follows a predictable three-step pattern. First, we form a belief or hypothesis about an investment. Maybe we think a particular tech company is the next big thing. Second, we actively seek supporting evidence. We read bullish articles, follow optimistic analysts, and focus on positive metrics. Third, and most dangerously, we ignore contradicting data. Negative earnings reports, management changes, or competitive threats get dismissed as temporary setbacks or noise. This cycle reinforces our original belief, even when the facts suggest otherwise. Let's look at a real-world scenario. An investor believes a tech company will revolutionize the industry and buys shares at a premium valuation. Once invested, confirmation bias kicks in. They read only positive analyst reports that support their view. They focus exclusively on rising user growth metrics while ignoring profitability concerns. They dismiss worries about increasing competition as overblown. The investor has created an echo chamber where only information confirming their initial belief gets through. This selective attention prevents them from objectively evaluating whether their investment thesis still holds true. How do you know if confirmation bias is affecting your investment decisions? There are 4 key warning signs to watch for. First is selective reading. You only consume news and articles that align with your investment view. Second is surrounding yourself with echo chambers, people who share the same bullish or bearish stance as you. Third is getting defensive or emotional when someone challenges your investment thesis. And fourth is ignoring red flags, dismissing negative earnings reports or management changes as merely temporary issues. If you recognize any of these patterns in your behavior, confirmation bias may be clouding your judgment. Confirmation bias comes with real financial costs. First, it leads to holding losing positions far too long. You refuse to sell declining stocks because you're constantly waiting for data that confirms they'll recover. Second, it causes you to miss better opportunities. You overlook superior investments because they don't fit your existing narrative or worldview. Third, it results in poor risk management. You overconcentrate your portfolio in positions you're emotionally attached to rather than diversifying objectively. These consequences can severely damage your long-term investment returns and financial goals. Overcoming confirmation bias requires deliberate effort. First, actively seek contradicting evidence. Don't just read bullish analyses, deliberately look for bearish viewpoints and skeptical reports. Second, play devil's advocate with yourself. Ask tough questions like, what if I'm wrong? What evidence would prove my thesis incorrect? Document these concerns honestly. Third, diversify your information sources. Follow analysts and experts with different perspectives. Engage with opposing viewpoints rather than avoiding them. These practices help break through the echo chamber and give you a more balanced view of your investments. Here are 3 additional strategies to combat confirmation bias. First, document your investment decisions. Write down your complete investment thesis and the specific reasons behind each decision. Review these documents regularly with fresh eyes to see if your reasoning still holds. Second, set regular review intervals. Schedule periodic checkpoints, maybe quarterly, to reassess your positions objectively with new data. Third, use pre-commitment strategies. Set stop-loss orders and target prices before emotions can influence your decisions. These mechanical rules help remove subjective bias from critical sell decisions. Let's recap the key lessons. First, confirmation bias makes us seek information that supports our beliefs while ignoring contradictions. It's a natural human tendency, not a character flaw. Second, it can lead to holding losing positions too long, missing better opportunities, and poor risk management. Third, combat it by actively seeking opposing views, playing devil's advocate, and documenting your investment decisions objectively. Fourth, use pre-commitment strategies like stop-loss orders to remove emotion from decision-making. By staying aware of this bias, you can make more rational, profitable investment choices. Thank you for watching this video on confirmation bias in investing. Remember, the goal isn't to eliminate all biases, that's impossible. The goal is to recognize when confirmation bias is affecting your decisions and take steps to counteract it. Stay objective, question your assumptions regularly, and always seek out contradicting viewpoints. By mastering your behavioral biases, you'll make better investment decisions and improve your long-term returns. If you found this helpful, please like and subscribe for more behavioral finance content. Happy investing!
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.